Okay, let's just jump right into this. Imagine it's 1995. The world looks totally different, and a father is making a pretty massive decision about his legacy. He's got 3 kids, and he wants to leave each of them something incredibly valuable. But here's the catch. He wants to leave them something worth exactly the same amount on day one. So he sets in motion this wild 30-year experiment. It's basically a real-life parable that reveals the absolute, undisputed secret to building long-term wealth, especially if you're a young, first-time investor just trying to wrap your head around the financial world.
So he decides to give his kids a tailored gift of equal value, but in 3 drastically different forms. Now, put yourself in their shoes for a second. Which one would you choose? I mean, would you want something tangible, something you could physically see and touch every single day? Maybe something completely secure and risk-free? Or what about something you barely even understood, but had this kind of unlimited potential? The father's choice here sets up literally one of the most powerful financial lessons we can ever learn.
All right, to make things perfectly fair, he gives each child the equivalent of about 1,200 US dollars. Back then in India, that was exactly 100,000 rupees in starting value. When he handed these gifts over, they looked completely equal. Honestly, no child got a single rupee more than the others. Well, at least that's how it looked on paper. Let's break down the actual risk and reward here, because it's fascinating. The oldest son gets a small shop in a super busy market district. This is a real, tangible asset, giving him monthly rent. It carries a moderate risk, but offers a very visible, steady reward. Then, the daughter gets a fixed deposit at the bank. Her risk level? Practically zero. It's safe, secure, and the expected reward is just slow, steady growth. Absolutely no sleepless nights for her. And then, there's the youngest son. He gets 100,000 rupees worth of Asian paint stock. To him, the risk feels sky high and super volatile, mostly because it's a total unknown. There are no guaranteed returns, no monthly paycheck, no physical building to look at. The guy knows absolutely nothing about paint and nothing about the stock market. Actually, he basically assumes he got the absolute worst deal of the 3. So how do these completely equal gifts play out over the first 10 years? Well, time passes. The oldest son is over the moon. He's reliably collecting that steady rent month after month, year after year. The daughter is watching her safe deposit grow, checking her statements, feeling totally secure. And the youngest son, he literally just ignores his shares. They're untouchable. Life gets busy, right? You've got your career, marriage, paying the bills. That investment account just sits there gathering dust. He hears people talking about the stock market going up and down, but he just totally tunes it out. And this right here is what brilliantly illustrates the fundamental difference between linear growth and compound interest. The oldest son's rent, that's linear. It represents simple interest. It's great income, but unless he's taking every single penny of that rent to buy more properties, his wealth is basically growing in a straight line. But compound interest, oh man, that is exponential. When an investment earns money and that money actually stays invested, those future gains start earning gains of their own. It's exactly like planting a tree. It grows branches, then those branches grow more branches, and eventually, boom, explosive growth. The youngest son's totally forgotten stock account was quietly acting just like that tree. He was essentially watching paint dry, but that paint was quietly compounding into a massive forest. You know, a lot of people think wealth is only created by working harder. And yeah, hard work is absolutely crucial, no doubt. But the world's greatest fortunes actually come from combining time with compounding. The legendary investor Warren Buffett hit the nail on the head when he said, "Time is the friend of a great business." At first, compounding looks painfully slow. It's almost invisible. But if you give it enough time, the math does something just extraordinary. While that youngest son was busy just living his life, compounding was quietly working in the background for him every single day. Okay, let's fast forward 30 years. Decades have passed. The father is gone, the kids are all grown up, and it is finally time to open the books and see how time and patience actually transformed those initial 100,000 rupee investments. And I gotta tell you, the outcomes are staggering. They completely flip the script on what these siblings originally thought about their gifts. Let's start with the oldest son. He did fantastically well. Over the decades, that little shop generated somewhere around 60 lakh rupees just in rental income. And on top of that, real estate prices skyrocketed, so the property itself appreciated massively. We're talking worth several crores today. Honestly, an incredible result from a tangible asset that served him well his whole life. The daughter did great too. Her secure fixed deposit did exactly what it promised to do. It just compounded steadily, decade after decade. After you factor in taxes and continuous renewals, her investment eventually reached a highly respectable, very safe 1 crore rupees. She got total financial security, and she never once had to panic over a market crash. But here is where the story gets wild. The youngest son, the guy who thought he was totally ripped off and completely ignored his gift, finally opens his account. And those forgotten paint shares, they had multiplied to roughly 1 crore rupees as well. How is that even possible? It's all because of stock splits, bonus shares, dividend reinvestment, and the underlying growth of the business itself. By doing literally nothing, his volatile, unloved asset harnessed uninterrupted compounding to match the safety of the bank and rival the massive returns of the real estate. Sadly, though, most people will never actually experience this kind of incredible, exponential growth. Why? Because we constantly interrupt the compounding process. When you're moving your money around every few months, or chasing the latest internet hype, or panic selling the second the market crashes, you aren't really investing. You are essentially digging up the seed before it even has a chance to grow into a tree. The youngest son only won because his sheer laziness forced him to leave his investment alone. It proves that patience is just infinitely more valuable than constant trading. So, what's the real takeaway from this explainer? It's this. Wealth isn't just about the face value of what you own today. It is entirely about what has the capacity to grow tomorrow. The father understood this on a very deep level. So many people get hyper-focused on today's value, but the most successful investors, they're looking at future value. A small asset like 100,000 rupees in a solid company, growing at a high compound rate, will eventually blow past a much larger asset that's only growing slowly. For all you young, first-time investors tuning in, I want you to treat this as your definitive study guide for long-term wealth. Step 1, choose an asset that actually grows, like a piece of a great business. Step 2, let it compound. Give the math time to do its thing. And step 3, do nothing. Seriously, doing absolutely nothing when the market is chaotic is arguably the hardest psychological challenge you'll face. But as this whole story proves, it is almost always the most profitable decision you can make. So instead of stressing out over what the market is doing this week or panicking over some temporary dip, I want you to ask yourself this. What could your investments become in 30 years? This whole experiment proves that the real winner wasn't determined on day one. It was determined by time. The absolute most valuable asset you can bring to the market isn't a high IQ or some perfect trading strategy. It's simply having the patience to let time do the heavy lifting. The clock is ticking, right? So how will you let your money spend its time?